Welcome to today's Explainer. We are tearing down an absolute financial giant today, the UK's largest retail bank, the one with that iconic black horse logo, Lloyds Banking Group, ticker symbol LYG. Now, on the surface, this bank looks like an investor's absolute dream. I mean, we're talking about a 17% return on tangible equity, a solid 4% dividend yield, a massive 30% dividend increase, and a staggering £10 billion share buyback program. It just sounds like the ultimate undeniable banking stock, doesn't it? Well, hold on to your hats, because as we peel back the layers, we are going to find some stark contradictions that the mainstream media completely ignores. We're putting Lloyds through the ultimate value gauntlet today to uncover the real story.
Okay, let's dive into this, because honestly, we're looking at one of the most shocking paradoxes in the market right now. On one hand, over on the left, we've got these elite UK bank metrics. The profitability and shareholder return numbers are practically screaming out to quality and dividend investors. But then you look to the right, and we hit these terrifying fundamental risks. A PEG ratio of 1.58, which is just way too high. A debt-to-equity ratio sitting at a bloated 210%, and most alarming of all, a recent earnings per share miss of 81%. We literally have a highly profitable bank that is simultaneously throwing up massive red flags.
I really want to pause here and dramatically emphasize this number. 81%. That is the size of the Q2 EPS miss that analysts just reported. Now, what makes this so incredibly fascinating and frankly concerning is that in the exact same H1 2026 report, revenue actually beat expectations by 5.6%. So top-line revenue is growing, doing great, right? But the actual earnings per share came in at just a fraction of a cent, about 0.0265 compared to the expected 0.14. How on earth does a bank beat on revenue but miss on earnings by 81%? It's the classic definition of profitless growth. Revenue is expanding, but something, whether it's costs, provisions, or one-time charges, is completely eating away the profits. The bank claims these are one-time factors, but come on, an 81% miss is not just a minor blip on the radar.
Section 1. The hidden red flags. We're going to look right past the mainstream financial headlines here to uncover what they are missing.
Now, what's really interesting about this slide is how rapidly the valuation and financial health concerns pile up. Let's start with Peter Lynch's golden rule. The P ratio should equal the growth rate. But Lloyd's PEG ratio is up at 1.58. Lynch prefers this to be below 1.0, which means the stock is significantly overpriced relative to its growth. Compounding this is that massive 81% EPS miss we just talked about. When you factor all that in, it's really no wonder Guru Focus calculates a GF value of just $0.94, compared to a recent price of around $6.19. That literally means they rate it as significantly overvalued, over 500% above its intrinsic value, with a below-average GF score of 57 out of 100. And on top of all of this, they're carrying a debt-to-equity ratio of 210%. That translates to 2.1x leverage. Look, in a healthy economy, banks use leverage to drive returns, sure, but in a UK economic downturn, this exact 2.1x leverage would amplify losses incredibly fast.
And the risks don't stop at the balance sheet. Take the UK housing market. Lloyds is the country's largest mortgage lender with a 19% market share. Right now, the UK housing market is widely described as lackluster. You've got stretched affordability and high mortgage rates. Any correction there hits Lloyds right on the chin. Meanwhile, as the stock prices surge from its 2020 lows, that famous dividend yield has actually dropped from the high single digits down to a range of 3.4 to 4.1%. One analyst even noted that if it drops below 3%, it's a sell signal. And who's at the helm weathering this storm? Management has almost no skin in the game, with insider ownership at just 0.06%. For a £67 billion bank, that's practically non-existent. Plus, with the stock trading near its 52-week highs around 115.9p, there's very little margin of safety, especially when you factor in the inherent regulatory and tax uncertainties that come with upcoming UK elections. Markets hate regulatory uncertainty, and political shifts inherently bring objective uncertainty to the table.
Section 2. The compelling green flags. Take a breath, because we are shifting gears. Despite those risks, here's why investors are still pouring money into Lloyds.
Honestly, these green flags are absolute powerhouses. It starts with an elite 17.1% return on tangible equity that comfortably exceeds the bank's own 16% target and shows a highly profitable core business driving £4.3 billion in statutory pre-tax profit in just the first half of 2026 alone.
This immense profitability earns them a guru-focused moat score in the top 2.2% of over 1,600 banks globally, and management is definitely sharing that wealth with a 30% dividend increase and a staggering £10 billion buyback that's already reduced shares outstanding by over 3% in the past year, all while keeping the payout ratio at a super safe 29 to 33%. All of this is underpinned by incredibly strong credit quality. They've got a 13.1% CET1 ratio, well above regulatory requirements, and a low beta of 0.91, which offers stability-seeking investors some serious peace of mind.
Let's move to Vivanda and see how this builds into an undeniable growth story within a mature sector. Analysts are projecting a massive 45.1% EPS growth in 2026 alongside 10.4% revenue growth. That is stellar. Backing up that growth is a superb Peter Oski F score of 7 out of 9, indicating excellent financial health across liquidity, profitability, and operating efficiency. Naturally, the analyst consensus is a solid buy, with an average target of about 124p, implying almost 18% upside. And the smart money agrees. Short interest is virtually non-existent at 0.01%, meaning nobody is betting against them, while institutional ownership sits at a massive 86%. Clearly, professional investors have extremely high confidence in this bank.
Section 3. The Ultimate Guru Face-Off. Time to bring in the jury. Let's see how Graham, Lynch, and Buffett would judge this conflicting data.
And this brilliantly illustrates exactly what we're up against. First up, Benjamin Graham, the father of value investing. He looks at the PE of 14.2 and the price to book of 1.43 and says, yes, that's acceptable. But then he sees that 2.1x debt to equity and the thin margin of safety, and he balks. His verdict? Mixed. Next, Peter Lynch. He loves the 45% forecasted EPS growth and the 10.4% revenue growth. But remember that 1.58 PEG ratio? It suggests that PE is totally disconnected from consistent growth, completely distorted by that one-time EPS miss. Lynch's verdict? Mixed. Finally, Warren Buffett. Buffett absolutely loves the 17.1% tangible ROE and the elite margins. But Buffett hates high leverage, and he strictly demands a wide, durable economic moat, not a narrow one. He simply can't predict earnings with that housing market risk looming. Buffett's verdict? Mixed. It's a unanimous, down-the-line, wait-and-see from all three legendary frameworks.
Section 4. The moat debate. Narrow or wide? Really, the entire investment thesis hinges on whether Lloyd's moat can withstand immense macroeconomic pressure.
Let's weigh the structural advantages against some severe vulnerabilities here. On the left, we see exactly why Guru Focus ranks their moat in the top 2.2% of global banks. They have a massive 19% mortgage market share, they hold 24% of all UK current accounts, they wield the instantly recognizable Black Horse brand, and they operate behind incredibly high regulatory barriers, with £1 trillion in scale. But look at the right side. That 19% mortgage share, it means they are literally the most exposed entity in the UK to a housing market correction during a brutal cost of living crisis with high interest rates. And they are facing this storm with 210% leverage. It's a market share moat that's undoubtedly strong, but it's not unassailable. The economic environment is going to be the ultimate stress test.
Section 5. The final verdict. So, how do we navigate this paradox of brilliant green and alarming red signals?
So the crucial point is that your decision really hinges on a few critical questions you have to answer for yourself. Number one, can Lloyds actually maintain that elite 17% return on tangible equity as the broader economy slows down? You have to ask yourself if the UK housing market will remain stable or if a correction is going to break their stride. Furthermore, is that massive £10 billion buyback sustainable long-term, or is it just a temporary sugar high? And will the dividend yield stay above that critical 3% sell threshold? Lloyds is undoubtedly one of the best UK banks, but right now, the risk-reward ratio is incredibly finely balanced. It just isn't heavily skewed to the upside.
If you're keeping this on your watch list, keep a very close eye on the immediate horizon. The major catalysts that could disrupt this delicate balance are the Q3 2026 earnings, expected in late October 2026, and any upcoming political or regulatory developments in the UK that could suddenly change the tax structure for these massive banking institutions.
Which brings us to the final thought I want to leave you with today. When you step back and look at the whole picture, are you a buyer at 115p to get your hands on that elite 17% return on tangible equity? Or does that massive 81% EPS miss just make you too nervous to pull the trigger? Remember, this explainer is a starting point, not financial advice. UK banking investments carry very complex credit, interest rate, housing, and regulatory risks. Do your own homework, read those 10Ks, and dig into the numbers for yourself. Thanks so much for joining me on this deep dive, and I'll see you in the next explainer. Stay sharp.